Imagine owning an apartment building right in the middle of Silicon Valley.
Right, prime real estate.
Exactly. The local tech industry is booming, hiring is just off the charts, and the true open market value for one of your units just skyrocketed by, say, 15% almost overnight.
Which is a landlord's dream scenario, usually.
You'd think so, right?
Yeah.
But then you look at your actual balance sheet, and your revenue from that specific unit barely crept up by maybe 5 or 6%.
Yeah, there's a massive disconnect there.
Totally. And if you're an outside observer looking at those numbers, you might think, wow, this landlord is simply terrible at their job. I mean, you're just leaving money on the table.
You'd think they were just completely mismanaging the property.
Right. But if you actually understand the underlying mechanics of West Coast real estate, you realize that landlord isn't losing money at all.
No, not even close.
They are actually sitting on this massive hidden reservoir of future cash flow, which is bound by state law, just waiting to be tapped.
It's wild. It completely alters how you have to analyze the fundamental value of these companies. The surface level numbers, they just don't tell the whole story.
No, they really don't.
You have to understand the legislative and geographical constraints to really see where the value is hiding.
Well, welcome to the deep dive. If you're looking at your portfolio right now, trying to, make sense of the commercial real estate market, you know it's a difficult landscape to map out.
Oh, it's incredibly volatile right now.
Extremely. You have historically high interest rates that are actively destroying property values in some sectors, while simultaneously, this severe structural housing shortage is keeping demand insanely high.
It's a massive macroeconomic tug of war.
It really is. So today, for our Talk Tickers breakdown, we are taking a microscope to a company that sits right at the epicenter of this tension. Essex Property Trust, ticker symbol ESS.
A fascinating company to look at right now.
Definitely. Our mission for this deep dive is to tear into their Q2 2026 earnings call. We're going to translate the Wall Street jargon, look at the headline numbers, and dissect the regional stories driving those numbers.
And we'll evaluate management's forward guidance, too.
Right. And ultimately, we want to give you, the listener, an actionable bottom line on whether this West Coast apartment giant is signaling a bullish or bearish future for your portfolio.
Essex is arguably the perfect case study for this current economic moment.
How so?
Well, they aren't a sprawling national conglomerate trying to be everything to everyone. They are hyper-concentrated.
Very specific markets.
Exactly. They operate exclusively on the West Coast, primarily in California and the Seattle metro area. And because they're so concentrated, they act as an amplifier for both sides of that tug of war you mentioned.
So the highs are much higher.
Yes, the highs are higher because of the massive wealth generation in those specific tech hubs. But the regulatory and developmental hurdles are also far more complex than in, say, the Sun Belt.
Yeah, that makes sense. Well, let's get straight into the data, starting with the headline numbers. And for anyone analyzing a real estate investment trust or a REIT, we aren't looking at traditional earnings per share.
Right. EPS is pretty much useless here.
Completely useless. The golden metric is Core FFO, or funds from operations, per share. And for Q2 of 2026, Essex reported a very clear beat.
A really solid beat.
Yeah. They exceeded the midpoint of their own guidance by 10 cents per share. But they didn't just have a good quarter. They meaningfully raised their full-year expectations.
Which is the real signal for investors.
Exactly. They bumped up the Core FFO per share midpoint by 20 cents, which is a 1.3% increase for the year.
And, a 1.3% increase might sound negligible if you're used to trading volatile tech stocks, but we have to contextualize the scale here.
Right. This isn't a software startup.
Exactly. In a multi-billion-dollar real estate portfolio where leases are signed for 12-month increments, revenue is generally highly predictable.
So surprise to the upside is a big deal.
A massive deal. Raising your bottom line metric by 1.3% halfway through the year is a substantial, aggressive move. It indicates management sees structural firmness in their markets that just wasn't apparent 6 months ago.
I want to unpack that FFO metric a bit more for you because it's the bedrock of how we evaluate these companies.
Yeah.
Traditional net income metrics are just fundamentally broken when applied to real estate.
They really are. They give a totally distorted picture.
Right. If you look at standard accounting, it factors in depreciation as an expense. The IRS basically tells you that your apartment building is physically degrading over 27.5 years.
So you have to subtract a portion of its value from your income every year on paper.
Exactly. But let's use an analogy to make this actionable. Imagine you buy a pristine, vintage 1960s Porsche.
Okay, love a classic Porsche.
Right. For tax purposes, you might be able to find a way to argue to the IRS that it's an aging asset, depreciating on paper.
Sure, it's getting older every year.
But if you look at your actual bank account and the actual market value of that car, it's going up. It's appreciating in value.
Because it's a rare, sought-after asset.
Exactly. If you only looked at the paper depreciation, you'd think you were losing money on the car.
Yeah.
FFO fixes that blind spot for real estate. It takes that paper depreciation and just adds it right back into the equation.
That vintage car analogy hits the core mechanism perfectly.
It strips away the accounting fiction, right?
Yeah, it shows you the actual cold, hard cash the REIT is generating from its operations. Collecting rent, paying the maintenance teams, paying the property taxes. Real estate, assuming you maintain the roof and the plumbing, is an appreciating asset in supply-constrained markets.
So subtracting its value every year obscures the actual cash-generating power of the business.
Exactly. FFO gives you, the investor, the clearest possible picture of the actual cash management has available.
Cash to distribute as dividends or reinvest.
Right, to upgrade properties or pay down debt. So a 10-cent beat in Core FFO means Essex generated 10 cents more per share in pure operational cash flow than they promised Wall Street.
But, a headline beat is really just a headline. If we are trying to figure out if this company is fundamentally outperforming, we have to follow the cash.
We have to see how the sausage is made.
Right. We need to figure out exactly how they manufactured that 10 cents. Was it driven by operational excellence? Or did they just get lucky?
Management did break down that 10 cents on the call, and the distribution is really fascinating.
Yeah, let's look at the buckets. 5 cents of the beat came from same property net operating income, or NOI.
Okay.
3 cents came from non-same property NOI, and then the final 3 cents came from lower than expected operating expenses.
And just to clarify for the listener, I know that adds up to 11 cents, but minor rounding offsets in the total share count bring the official print to a 10-cent beat.
Good catch. We should probably delineate those buckets, though, because they tell very different stories about the company's health.
They absolutely do. Let's start with the same property bucket. That's their core stabilized portfolio.
These are the apartment communities they have owned and operated for more than a year, right?
Yes. It's the truest apples-to-apples comparison of how their baseline business is running. Generating 5 cents of outperformance there means they are actively pushing rents higher or keeping occupancy higher than they initially modeled.
Right. It's organic growth. And then the non-same property bucket refers to the dynamic parts of the portfolio.
Buildings they recently acquired or new developments?
Yeah, projects they just finished building and are currently leasing up for the first time. Getting a 3-cent beat there means their recent capital allocation bets, specifically some newer acquisitions in Northern California, are yielding higher immediate returns than they projected.
It means they bought right.
Exactly. But I really want to zero in on that final bucket, the 3 cents from lower operating expenses.
Yes. The tax situation.
Right. Management explicitly stated on the call that this expense savings was driven by favorable property taxes in California, specifically successful Proposition 8 appeals. And they admitted these savings are, quote, one-time in nature.
I see where you're going with this pushback.
I mean, if a third of your earnings beat is just a fortunate tax refund, that drastically changes the narrative for me.
It definitely shifts the tone of the quarter.
Are analysts getting overly excited about a temporary administrative win rather than a durable acceleration in the actual business of renting apartments?
It's the exact right question to ask.
Yeah.
And to answer it, it requires us to understand the mechanics of California tax law, just to gauge how lucky this really was.
Because it wasn't just a typo on a tax form.
No, not at all. This isn't like finding a $20 bill on the sidewalk. This is active, aggressive corporate management.
Okay, walk us through it.
In California, you have Proposition 13, which was passed back in the late 70s. Prop 13 fundamentally caps how much property taxes can increase year over year.
It's usually capped at around 2%, right?
Exactly, usually 2%, regardless of how much the actual market value of the property skyrockets. It provides incredible predictability for long-term owners like Essex. Their tax burden on a building they bought in 1995 is astonishingly low compared to a building they bought last year.
That's a huge structural advantage. But Prop 13 only protects you on the upside. What happens in a downturn?
That's where Proposition 8 comes in. Prop 8 allows property owners to appeal their tax assessment if the current temporary market value of their property drops below its Prop 13 assessed value.
Oh, interesting. So it's a downside protection.
Exactly. Think back to 2023 and 2024. Interest rates spiked, cap rates expanded, and the theoretical transaction value of commercial real estate just plummeted.
Even if the buildings were still totally full of paying tenants.
Right. The physical cash flow was fine, but the paper value of the building dropped. Essex has teams of tax professionals whose entire job is to track this stuff.
So they went on the offensive.
They absolutely did. They looked at the market, compiled the data, went to the county tax assessors across California, and successfully argued the open market value of these specific properties has temporarily fallen due to the high interest rate environment. You must lower our assessed value for this year.
And they actually won those appeals.
They won them, and that saved them 3 cents a share in operating expenses.
Which, to be clear to you listening, is phenomenal management.
Yeah.
You want a management team that ruthlessly optimizes every single line item on the income statement.
Absolutely. It's highly competent execution.
But to my original point, it is not recurring revenue.
No, it's not. By definition, as the market recovers, those Prop 8 tax reductions will reverse, and their tax burden will normalize back up to the Prop 13 baseline.
And management was pretty transparent about this on the call.
They were. However, to determine if the core business is truly accelerating, we have to strip out that tax benefit entirely and look at the underlying metrics.
Let's do that. Let's look at the metrics, stripped of all that tax noise.
When you do that, the picture remains incredibly robust. In the quarter, their same property revenue growth was 20 basis points ahead of their internal expectation.
That's solid.
And more importantly, they increased their full-year guidance for same property net operating income growth by a massive 70 basis points.
Wow, bring it up to what, 2.8%?
Exactly, 2.8%. They also bumped their full-year same property revenue growth expectation up by 40 basis points.
And you don't raise full-year organic revenue guidance by 40 basis points just because of a lucky property tax.
You absolutely don't. You raise it because your scheduled rents are coming in higher, your physical occupancy is holding stronger, and your ancillary income is outperforming.
Ancillary income being things like parking fees, pet rent, and utility bill backs.
Right. All of that is outperforming. The tax break padded the quarter, certainly, but the fundamental engine of the business is running much hotter than anticipated.
This brings up a really critical transition point for us. You just mentioned they bumped their same property NOI growth up to 2.8% for the year.
Right.
But that is a blended average for the entire company. And when you were analyzing a real estate portfolio concentrated on the West Coast, a blended average is almost useless.
It really obscures the truth.
It totally obscures the extreme volatility happening on a local level. You can't just look at the spreadsheet. You have to look at the map.
I agree completely.
The story behind Essex's outperformance this quarter is really a tale of 3 completely distinct regional economies acting in vastly different ways.
Geography is destiny in real estate. The macroeconomic forces we talked about, interest rates, national job growth, they impact these regions, but the microeconomic factors in each specific metro area are what ultimately dictate the rent growth.
Right. So let's break down the Essex map. Let's start with the undisputed heavyweight champion of their portfolio right now, the region that is single-handedly pulling that blended average higher.
You're talking about Northern California.
Northern California.
Yeah, NorCal is functioning as the engine of the entire REIT right now. Angela Kleiman, the CEO of Essex, she flat out called it the leading multifamily market in the entire country right now.
That's a huge claim.
It is, but the numbers back it up. In the second quarter, they posted a blended rent growth of 6.5% in Northern California.
Just to put that 6.5% into context for you listening, we are currently in an environment where the broader national narrative is that inflation is cooling off and rent growth is stagnating.
Right, rents are actually falling in a lot of places.
Exactly. If you look at major Sunbelt markets, places like Austin, Phoenix, or Atlanta, you are actually seeing rents go negative. They are dropping year over year because so much new apartment supply has flooded those markets.
They just overbuilt.
They completely overbuilt. So to print a 6.5% positive rent growth in NorCal is a massive statistical outlier. We have to understand the mechanics of why that is happening.
The mechanism driving that 6.5% is a textbook collision of violently restricted supply, meeting a sudden reacceleration in highly capitalized demand.
Let's tackle the supply side first, because it seems like the strongest defensive moat Essex has.
It absolutely is. Angela noted on the call that the supply of new apartments in Northern California is at historic lows. Last year, the total new supply delivered to the market represented roughly 0.5% of the existing housing stock.
0.5%, that's basically nothing.
It's a rounding error. Compare that to a market like Seattle, which was closer to 1%, or some Sunbelt markets that were seeing 3 or 4% growth in supply.
And we need to explore why that supply is so restricted. Because it's not just because interest rates made construction loans expensive.
No, though that's certainly part of it right now.
But the Bay Area and Silicon Valley have some of the most complex, restrictive, and lengthy entitlement processes in the entire world.
Oh, it's a nightmare for developers.
You have incredibly strict zoning laws, exhaustive environmental impact reviews, and fierce local opposition to density, often referred to as NIMBYism. Out in my backyard.
Not to mention the sheer cost of the land itself and the union labor rates required to build there.
Right. If you are a developer looking to build, say, a 300-unit high-rise in Santa Clara, you might spend 5 to 7 years just getting the legal permission to break ground.
And that's assuming the city council doesn't kill the project entirely halfway through.
Exactly. This creates an impenetrable fortress around existing landlords. If Essex owns a stabilized, high-quality apartment community in Silicon Valley today, they have virtually zero fear that a competitor is going to build a brand new complex across the street and start stealing their tenants with move-in specials.
The supply pipeline is effectively choked off permanently.
It's an incredible structural advantage.
It is, and that structural lack of competition gives the existing inventory immense pricing power. But you still need demand to push the price up.
You still need people who want to live there and can pay the rent.
Right. And the demand narrative in Northern California has completely flipped over the last 18 months.
Oh, definitely. During the pandemic, the prevailing media narrative was the tech exodus. Everyone was supposedly leaving San Francisco and Silicon Valley for Texas or Florida.
The famous move to Miami.
Right, moving to Miami or Austin.
Yeah.
But the data Essex is reporting completely contradicts that. They are seeing sustained, positive migration trends back into the region.
It's the gravity of the tech ecosystem. You just can't replicate Silicon Valley by moving your laptop to Miami.
No, you can't. The concentration of venture capital, specialized engineering talent, and the sheer density of innovation, especially with the current explosion in artificial intelligence, is pulling people right back.
Exactly. The AI boom requires intense in-person collaboration and specialized hardware that is just heavily concentrated in the Bay Area. And this is translating directly into leasing momentum for Essex.
And what's particularly notable is the durability of this demand, right?
Yeah, Angela pointed out that their peak leasing momentum in NorCal is extending well beyond the typical seasonal patterns.
Because usually in a normal year, you get a rush of leasing activity in the spring and early summer, right? People moving after graduation or before the school year starts.
Exactly, and then demand drops off sharply in the fall. But in NorCal, the demand curve just kept pushing higher, completely defying the seasonal cool down.
It's a fascinating dynamic. But if Northern California is the superstar, we need to talk about Seattle, which operates a bit like the middle child of the Essex portfolio right now.
Middle child is a good way to put it.
It's performing adequately, but the internal dynamics are just heavily fragmented.
Seattle is a perfect case study in microgeography. The headline number for the Seattle region was a 2.8% blended rent growth by the end of June.
Which is a massive sequential improvement. If you look back at March, Seattle was only posting 1.4% growth.
So the pace of rent growth essentially doubled in a matter of months, hitting its seasonal peak right around early July.
But you can't just look at Seattle as a monolith. If you dig into the submarkets, you really have two totally different economies operating just miles apart.
Right, you have the Eastside and the urban core.
Yeah, you have the Eastside cities like Bellevue and Redmond, which are heavily dominated by massive tech campuses. And then you have the urban core, the Central Business District, or CBD, of Seattle proper.
And the performance gap between the two is stark. The Eastside posted a very healthy 3.2% rump growth. The CBD, on the other hand, barely scraped together a 1% growth rate.
This divergence is directly correlated to how the major tech employers are deploying their capital and their workforces, isn't it?
Yes. Angela specifically mentioned that management is highly encouraged by recent office expansion announcements from major tech players. But those expansions are overwhelmingly targeted at the East Side, not downtown Seattle.
However, there is a critical mechanical concept that you as an investor need to grasp here regarding these corporate announcements.
There is a substantial lag time.
A huge lag time between a tech CEO announcing an expansion and an Essex leasing agent actually signing a new lease.
I'm glad you brought this up. It's a trap a lot of retail investors fall into.
You read a headline on Bloomberg that a major tech giant is leasing 1 million square feet of office space in Bellevue, and your immediate instinct is to buy local real estate stocks because you assume a flood of highly paid engineers is arriving tomorrow.
But the timeline is much, much longer than that. It can be measured in years.
Walk us through the physical mechanics of a corporate expansion.
Step 1 is just the announcement and the signing of the commercial lease. Step 2 is the actual physical build-out of the space. You don't just move engineers into an empty concrete shell.
Right. You have to hire architects, navigate commercial permitting,
Install specialized networking infrastructure, build out the cafeterias and amenities. That process alone can take 12 to 18 months. Only when the facility is nearing completion does the company actually ramp up for aggressive hiring or mandate relocations.
So when Essex sees these announcements on the Eastside, they aren't projecting immediate revenue jumps.
No, not at all. They are modeling future demand waves that might not hit their buildings for another year or two.
Precisely. They're positioned perfectly in Bellevue and Redmond to capture that high-income renter base when the physical hiring wave actually hits.
And crucially, they will be capturing that demand exactly as the broader Seattle market sees its new supply pipeline dry up. It's a delayed catalyst, but a very potent one.
Meanwhile, the central business district of Seattle is a completely different story. One of the analysts on the call asked management point blank if downtown Seattle could surprise to the upside and start putting up massive numbers like Northern California.
And management's response was incredibly measured, honestly borderline pessimistic.
Yeah, they pointed out 2 structural headwinds for the CBD. First, downtown Seattle historically has a much higher percentage of new apartment supply coming online compared to the sprawling suburbs of the Eastside.
There is simply more competition downtown for renters.
Exactly. Second, the employment base isn't as centralized anymore. The big tech employers have intentionally distributed their footprints across the broader metro area.
You don't have to live downtown to have a short commute to a premier tech job anymore.
Right. So a robust recovery in downtown Seattle is going to be a slow, grinding process, heavily dependent on broader quality of life improvements in the urban core.
Which perfectly transitions our analysis to the third, and frankly most problematic region in the portfolio, the laggard, Southern California.
Southern California is the heavy anchor currently dragging down the Essex speedboat. And we cannot understate how important this region is to the company.
It's massive.
Southern California represents roughly 40% of their entire operational footprint. It is a massive chunk of their capital. And yet it only generated a meager 1.4% rent growth in the quarter.
It's a real drag on the numbers.
Why is SoCal barely treading water while NorCal is flying?
The divergence comes down to macro correlation. Northern California has its own localized, almost insulated tech ecosystem. It can defy national economic gravity because it's fueled by global venture capital and massive structural shifts like AI.
And Seattle has specific tech titans driving its east side recovery.
Right. Southern California, however, and specifically Los Angeles, does not have that singular, concentrated economic engine right now.
Because it's so diversified.
Exactly. The SoCal economy is highly diversified entertainment, logistics, aerospace, general commerce, and because it is so diversified, it is deeply correlated with the overall United States gross domestic product and national employment trends.
And the national data right now is very clear. Job growth is tempering. The U.S. economy is adding fewer jobs this year than it did last year. The labor market is cooling.
And when the national engine cools down, Los Angeles cools down right with it.
Did management break down the submarkets in SoCal at all?
They were very specific. They noted that Orange County and San Diego are holding up relatively well.
Okay.
San Diego, in particular, is starting to turn a corner after having to absorb a massive wave of new apartment construction over the last 2 years. That supply is finally getting leased up, but Los Angeles is just stuck in the mud.
Stuck in the mud. Yeah. How did they describe it on the call?
They described LA as a stable market, which is corporate speak for not growing.
Right. No growth.
They were quick to point out that it isn't fragile occupancy in LA is still sitting comfortably above 95%, so they aren't hemorrhaging tenants. But they have zero pricing power.
They can't push rents.
No. They are entirely dependent on a reacceleration of the sluggish national economy to push rents higher in LA.
Okay, this brings me to a massive logical disconnect in the numbers that we have to explain to you listening. We've established the map. Northern California is booming at 6.5%.
Yep.
Seattle is improving at 2.8%. Southern California is dragging at 1.4%. Yet, when you look at the company's official guidance for the full year of 2026, they are only projecting a 2.5% blended rent growth.
You're looking at the math and seeing a gap.
A huge gap. I mean, if your most profitable, highest growth market, NorCal, is putting up 6.5%, and your worst market, SoCal, is at 1.4%, how on earth does the blended average settle all the way down at 2.5%?
It doesn't seem to add up.
Southern California is big, but it's not big enough to drag the math down that far on its own. Are they sandbagging the numbers, or is there an invisible ceiling capping their revenue in Northern California?
It is the invisible ceiling, and this is where regulatory analysis is just as important as financial analysis. You simply cannot accurately model West Coast real estate without intimately understanding state legislature.
So what's the specific mechanism capping Essex's growth right now?
It's California Assembly Bill 1482, universally known as AB 1482.
The statewide rent control mandate.
Exactly. Passed in 2019, AB 1482 fundamentally altered the operational mechanics of being a landlord in California. The law places a strict cap on how much a landlord can increase the rent on an existing tenant over a 12-month period.
Right, and the formula is typically 5% plus the local rate of inflation, right?
Yes, but it carries a hard absolute maximum cap of 10%.
We really need to explain how this actually plays out in the real world, because it creates bizarre market distortions. Let's go back to our Silicon Valley example.
Okay, let's look at the unit.
Let's say Essex has an apartment that was renting for $2,000 a month last year. But because the AI boom has severely constrained supply, the actual open market value of that apartment, what a brand new tenant walking in off the street would gladly pay today, has jumped by 20%. The market rate is now $2,400.
Right. In a free market, when that lease comes up for renewal, Essex would tell the tenant, your new rent is $2,400. If the tenant doesn't want to pay it, they move out, and Essex leases it to someone who will.
But under AB 1482, Essex is legally prohibited from capturing that market reality.
Even if the market jumped 20%, Essex is capped at, let's say, an 8% increase based on the inflation formula. So they can only raise the rent from $2,000 to $2,160.
This creates a massive gap between the rent Essex is actually collecting and the theoretical value of the apartment. In real estate terminology, this gap is called loss to lease.
And loss to lease is the defining characteristic of Essex's Northern California portfolio right now. Management stated they have a loss to lease of around 6% in NorCal.
Wow, 6%.
That means their current rent roll is sitting 6% below the actual open market value of their buildings. It is a massive reservoir of embedded, pent-up revenue growth.
But they can't access it all at once. It fundamentally extends their recovery timeline.
It acts as a governor on the engine. They can only capture that 6% incrementally year after year as leases renew, grinding their way up to market value.
And this creates a fascinating secondary effect on tenant behavior. I mean, if you are that tenant paying $2,160 for an apartment that is actually worth $2,400, are you going to move?
Absolutely not. You're being heavily subsidized by the state to stay exactly where you are.
Because if you move across the street to a comparable building, that new landlord can charge you the full $2,400 market rate, right?
Because AB 1482 only applies to existing tenants, not new move-ins. This phenomenon is called vacancy decontrol.
Exactly. Because tenants realize they have a sweetheart deal relative to the open market, they don't move. Tenant retention skyrockets. Turnover plummets.
And while that sounds bad because it prevents Essex from resetting the unit to market rate, management explicitly stated on the call that they actually prefer this dynamic. They have not changed their operational philosophy. They want to maximize renewals.
Wait, why? If moving a tenant out allows you to jump the rent by 20%, why wouldn't Essex want maximum turnover?
Because turnover is incredibly expensive. When a tenant moves out, you suffer a vacancy gap, maybe 3 or 4 units, where the unit generates zero revenue.
Plus the prep costs.
You have to send in a crew to paint the walls, deep clean the carpets, maybe replace appliances. You have to spend marketing dollars to find a new tenant. And in softer markets, you might even have to offer a concession, like 1 month of free rent to get the lease signed.
So they've done the math.
Essex has run the math. They know that unless they can push new lease rates significantly higher, usually above a 6% premium, they are mathematically better off keeping the existing tenant, taking the maximum allowable 8% increase under AB 1482, and saving thousands of dollars in turnover costs.
So when we look at that 2.5% full-year guidance, it starts to make perfect sense.
Right.
You have Northern California, which is fundamentally booming, but whose revenue growth is artificially flattened and elongated over years by AB 1482.
You have Seattle, which is growing but waiting on physical tech expansions to materialize.
And you have Southern California, which represents 40% of the portfolio, acting as a massive anchor. In fact, management mentioned they actually have a slight gain to lease in SoCal.
Yes, gain to lease is the exact opposite of what's happening in NorCal. It means their existing tenant base in Southern California is actually paying slightly more than what the current stagnant open market would dictate.
Yeah.
Because the LA market is so soft, Essex doesn't have the leverage to push renewal rates heavily there without risking the tenant moving down the street for a cheaper deal. You blend the regulatory constraints of NorCal with the macroeconomic sluggishness of SoCal, and 2.5% is the realistic, mathematically sound outcome for the year.
That deep dive into the map gives us the perfect foundation to look at management's forward guidance. We know the regional constraints. We know where the growth is bottlenecked. So how is Essex steering the ship for the back half of 2026 and setting for 2027?
Let's start with the near-term caution, specifically their guidance for the third quarter, because for an investor, this looks a bit alarming at first glance.
It definitely does. Management is forecasting Q3 Core FFO at $3.99 per share. That is a 9-cent sequential drop from the $4.08 they just reported in Q2. Earnings are literally going backwards quarter over quarter. Why the sudden dip?
It is entirely driven by the expense side of the ledger, not a collapse in revenue. There are 3 specific mechanisms driving this 9-cent drop, and none of them point to a fundamental deterioration of the business.
Okay, let's hear them.
First, you have the normalization of California property taxes. We spent a lot of time analyzing those one-time Prop 8 savings that padded Q2. Those savings are booked, they are done.
So moving into Q3, their tax burden resets to the normal, higher Prop 13 baseline.
Right. That automatically creates a sequential expense headwind.
So the second factor is purely seasonal, right? Utilities.
Yes. It's summer in California. Electricity usage spikes massively due to air conditioning. While Essex bills a lot of utility costs back to tenants, they still shoulder a significant portion of the energy burden for common areas, amenities, and vacant units.
That creates a natural spike in operating expenses in the third quarter every single year.
Exactly. But the third reason is the most interesting from a corporate strategy perspective. They called it controllable spending.
Oh, right. They explicitly noted that during the first half of the year, their controllable expenses, things like large-scale landscaping projects, exterior painting, preventative maintenance, or unit upgrades, were running significantly lower than they budgeted.
But they didn't cancel those projects. They just pushed them to the back half of the year.
Why do that?
This is a classic REIT management tactic. When you have a quarter where revenue is unexpectedly strong, or you secure a massive one-time tax break, you use that financial cushion to absorb heavier maintenance spending later in the year without blowing your annual budget.
So they are intentionally backloading their property improvement expenses into Q3 and Q4.
Correct. So the 9-cent sequential drop in FFO isn't because tenants stop paying rent. It's because Essex is absorbing normal seasonality, losing a temporary tax break, and proactively spending money to maintain the physical quality of their assets.
Okay, so the immediate horizon is a bit bumpy on the expense side. But if we pull the lens back and look at the long-term optimism, the narrative completely shifts.
It's a totally different story for 2027.
Yeah. Management spent a significant portion of the call talking about 2027, and the macro outlook they painted for the West Coast is incredibly bullish. And it almost entirely hinges on a single powerful mechanism, the supply cliff.
If you want to understand the long-term viability of an apartment landlord, you really only need to ask one question. How many construction cranes are operating within a 5-mile radius of their buildings?
And what Essex is tracking right now is a massive industry-wide deceleration in new apartment deliveries. The pipeline is emptying out.
Barb, their CFO, explicitly noted that the supply of new apartment buildings across all their markets is going to trend significantly lower in 2027 compared to 2026.
We need to explain why this supply cliff is happening, because it is a direct consequence of the macroeconomic environment. For a developer to build a 300-unit apartment complex, they don't just use cash, obviously.
No, they utilize a capital stack.
Typically comprising about 30 to 40% equity and 60 to 70% debt. a construction loan.
Right. And over the last 3 years, the Federal Reserve hiked interest rates aggressively. The Secured Overnight Financing Rate, or SOFR, which most construction loans are pegged to, went from near zero to over 5%.
That shift completely destroys the financial viability of new construction.
It really does. When a developer models a new project, they have to factor in an interest reserve, the money they will owe the bank while the building is under construction and not generating any rent.
When rates were at 3%, that interest burden was manageable.
But at 7% or 8%, the interest expense eats the entire profit margin of the project before a single shovel hits the dirt.
And then compound that with the reality that construction costs the price of lumber, concrete, steel, and union labor on the West Coast have remained stubbornly high.
When you have sky-high capital costs colliding with sky-high physical construction costs, developers simply stop building. They abandon the projects on the whiteboard.
And because large-scale multifamily development takes 3 to 4 years from planning to completion on the West Coast, the projects that were canceled in 2023 and 2024 are creating a massive void in new supply for 2027 and 2028.
Essex knows this is coming. Because new supply is vanishing, Essex won't need the local economies to generate a massive wave of new jobs just to keep their buildings full.
Right? Even if demand stays completely flat, the shrinking supply of available housing gives existing landlords immense pricing power.
It's the rawest form of supply and demand dynamics, amplified by the fact that the demand side is essentially captive.
Management touched on this briefly, but the affordability gap on the West Coast right now is staggering.
It is genuinely incredible.
If you are a high-earning tech worker in Silicon Valley and you want to buy a starter home, you are facing a multi-million-dollar purchase price with a 7% mortgage rate. The monthly cost of homeownership is exponentially higher than the cost of renting a luxury apartment from Essex.
Management explicitly confirmed this on the call. They are not seeing their tenants move out to buy houses. The financial barrier to entry for homeownership has essentially trapped high-income earners in the rental pool.
When you combine a captive, high-earning renter base with a total collapse in new apartment construction, you have the recipe for sustained multi-year pricing power.
The setup for 2027 is historically favorable for existing owners.
Which naturally leads to the next question regarding their capital allocation. If 2027 is going to be this incredible environment with no new supply, what is Essex doing with their billions in capital right now? Are they rushing out to buy land and build new towers to capture this future demand?
They are acting with extreme caution, actually, which should be very reassuring to investors.
Really? Tell us about Ryland's comments.
Ryland, the executive who handles investments for Essex, detailed their development philosophy. He acknowledged that the theoretical economics of development have improved very slightly over the last few months, primarily because rent growth in places like NorCal is currently outpacing the growth of construction costs.
But development is inherently risky.
Highly risky. You are placing a massive financial bet on what the market will look like 3 to 4 years in the future. So Essex is holding off on starting any massive new projects until the economics provide a massive margin of safety.
And they gave a specific metric for that margin of safety on the call. Ryland stated they are targeting a strict 100 to 150 basis point yield spread over what they could achieve by simply buying an existing stabilized property.
Let's break down exactly what that means, because it's a crucial concept for understanding commercial real estate valuation.
Yes, let's explain cap rates.
The metric they use is a cap rate, or capitalization rate. It's essentially the annual unlevered return you can expect on an investment. If Essex takes $100 million today, they can go out into the market and buy an existing, fully occupied apartment building that yields a 4.5% cap rate.
They get immediate cash flow, they take on zero construction risk, and they take on zero lease-up risk.
Exactly. So if buying an existing building yields 4.5% risk-free, what Ryland is saying is that Essex will not take on the massive headaches of entitlements, construction delays, and market uncertainty to build a new building unless they can conservatively project that the finished product will yield at least a 5.5% or 6.0% return upon stabilization.
They demand 100 to 150 basis point premium, a 1% to 1.5% higher yield to compensate them for the risk of development.
And right now, the math just isn't there in most markets. The costs are still too high relative to the projected rents to hit that 6% yield target.
They did mention they have one project currently under construction in South San Francisco that is trending favorably, right?
Yes, and they are evaluating another piece of land down the peninsula. But they remain highly disciplined. They are not chasing growth for the sake of growth. They are aggressively protecting their capital.
Which makes total sense. Why take the risk of building when you can efficiently buy existing assets or recycle your capital? However, this disciplined approach leads to a major pushback I have against management's overall narrative. I really want to look at the dissonance between their long-term macro view and their short-term financial guidance.
Where do you see the disconnect?
Well, management spent a significant portion of this call hyping up the structural advantages. Rents haven't even peaked yet in Northern California. The 2027 supply cliff is going to eliminate competition. The affordability gap is keeping tenant retention at record highs. They have massive pricing power.
All very true.
Yet, when you look at their full-year guidance for 2026, they are explicitly factoring in macroeconomic uncertainty to keep their blended rent growth projection at a meager 2.5%. They are citing geopolitical risks and a slower national economy.
I see where you're going.
So my question for you is, are they intentionally sandbagging? Are they artificially depressing their current guidance so they can easily step over a low bar and report massive beats in Q3 and Q4? Or are they genuinely terrified that a broader U.S. economic recession is going to hammer their massive Southern California portfolio and drag the entire company down, regardless of how strong Silicon Valley is?
It's the classic analyst dilemma when reading forward guidance. Are we looking at prudent conservatism or intentional sandbagging? Given the specific geographical exposure of Essex, I firmly believe it is prudent conservatism, heavily weighted by the reality of Southern California.
You don't think it's sandbagging?
No. Angela was very transparent about the macro data. The broad U.S. economy is objectively slower this year than last year. Job growth is decelerating. When 40% of your entire net operating income, your Southern California portfolio, is inextricably linked to the health of the national economy, you simply do not have the luxury of aggressive optimism.
So they have to pad the downside risk.
They absolutely have to. They know Northern California is robust, but they also know that if a severe national recession hits and unemployment spikes broadly, Los Angeles will suffer and that pain will eventually bleed up the coast.
So they are choosing to issue guidance based strictly on the visibility they have today.
Exactly. A stagnant, sluggish SoCal offsetting a strong but legally capped NorCal. They are not modeling a catastrophic drop-off in the second half of the year, but they are absolutely refusing to model a heroic acceleration.
If the economy achieves a soft landing and holds up, Essex will likely beat this 2.5% guidance handily.
And if the economy stumbles into a recession, management has already baked that risk into the expectations. It is a highly defensive, fortified posture, which is exactly how a fiduciary should act in a volatile interest rate environment.
That defensive posture leads us perfectly into the final segment of our deep dive, the bottom line. We've analyzed the headline beats, we've mapped the regional tug-of-war, we've unpacked the regulatory constraints of California law, and we've evaluated management's cautious but optimistic guidance. Now, we have to synthesize all of this data into an actionable verdict.
It's time to make a call.
If you were an investor looking at your portfolio, how do you value Essex Property Trust right now?
Any verdict on a commercial real estate company in today's environment has to begin with an autopsy of their balance sheet. The operation metrics we discussed, rent growth, occupancy, they do not matter if the debt structure of the company is toxic.
And Essex's balance sheet is the definition of a financial fortress. Let me rapid fire the armor they have built around this company. Their net debt to EBITDA ratio is sitting at 5.4 times.
Which is fantastic.
For context, in the REIT universe, a ratio under 6 is generally considered highly conservative and incredibly solid. It means they generate massive amounts of cash relative to their total debt load. Furthermore, they have over $1 billion in available untapped liquidity.
A huge safety net.
But the most vital metric is their maturity schedule. They have minimal debt maturities coming due over the next 12 months.
That last point is paramount. And it's the primary reason Essex is thriving, while smaller private syndicators are facing total collapse.
The bloodbath currently happening in commercial real estate is concentrated among operators who utilized short-term floating rate debt.
Exactly. Imagine a private developer who bought a building 3 years ago using a bridge loan at 3% interest, assuming they could renovate it, raise rents, and refinance. But the loan matures today, and the only refinancing options are at 7% or 8%.
The interest expense literally wipes out the cash flow of the property.
They are forced to hand the keys back to the bank or sell the asset into a depressed market at a massive loss. Essex completely insulated themselves from this scenario. They utilized long-term fixed-rate corporate debt.
They don't have a gun to their head forcing them to sell properties to cover a margin call. They have locked in their capital costs, they have a billion-dollar war chest, and they can afford the ultimate luxury in real estate: patience.
And while they are being patient with large-scale developments, they are executing what I call smart money moves in the background. These are the strategic, incremental capital allocation decisions that rarely make the front page of the Wall Street Journal, but dramatically improve the long-term risk profile of the company.
We should highlight a few of those moves because they speak to the sophistication of the management team. First, the litigation settlement. During the quarter, Essex announced they settled a massive 4-year multi-litigation suit.
Yeah, Angela noted on the call that the sheer magnitude and complexity of this specific lawsuit was highly unusual for Essex. Management looked at the situation, calculated the exorbitant legal costs and internal distraction required to fight it for several more years, and made the executive decision to settle it, pay the cost, and clear the decks.
And we should clarify for you listening, this settlement was entirely separate from the highly publicized Department of Justice investigation into the RealPage pricing software that is currently impacting the entire multifamily industry. This was a separate legacy issue.
Getting a massive, distracting lawsuit off the balance sheet allows management to focus 100% of their energy on operations. It's a huge qualitative win.
The second smart money move involves their capital recycling program. Essex sold a joint venture asset in San Jose during the quarter, and they achieved a mid-4% cap rate on the sale.
We discussed cap rates earlier regarding development, but we really need to contextualize a mid-4% cap rate on a sale in this specific interest rate environment. The 10-year Treasury is yielding around 4%.
So if an institutional buyer is willing to purchase a building from Essex at a 4.5% yield, it means that buyer is paying an incredibly high premium.
They are accepting a very low immediate return relative to the risk-free rate because they fiercely believe in the long-term appreciation and rent growth potential of that specific San Jose asset.
It's a phenomenal valuation. Essex had debt maturing on this specific joint venture. They tested the open market, saw incredibly aggressive institutional demand for high-quality Silicon Valley assets, and they capitalized on it.
They sold the building, realized the gain, and now they can take that capital and redeploy it into other areas of the portfolio where they believe they can achieve better risk-adjusted returns.
Perhaps paying down debt or funding that South San Francisco development. It is active, ruthless portfolio management.
They are also actively de-risking the fringes of their business, specifically their preferred equity book.
For listeners who might not be familiar with this, Essex doesn't just own and operate apartment buildings. They occasionally act as a mezzanine lender. They provide preferred equity financing to other smaller developers who need capital to finish a project.
It's a higher yield investment for Essex, but it also sits higher on the risk spectrum because if the developer defaults, Essex is entangled in a messy capital stack.
Barb mentioned on the call that they received roughly $90 million in redemptions this quarter, meaning the developers successfully finished their projects and paid Essex back.
And instead of immediately lending that $90 million back out to new developers in a shaky economic environment, Essex has intentionally decided to shrink this entire book of business. They have sized their preferred equity exposure down to a highly manageable $100 million.
They are consciously choosing to reduce their high-yield risk exposure and focus on their core competency: owning stabilized apartments.
All of this analysis leads us to the final, definitive question. Based on the Q2 2026 earnings call, the regional dynamics, the regulatory environment, and the balance sheet, what is the verdict? Are we bullish or bearish on Essex Property Trust?
Give it to us straight.
Based on the underlying mechanics of the West Coast market, my stance is definitively bullish, but it requires a specific, non-negotiable qualifier. This is a bullish signal exclusively for the long-term patient investor.
Okay, I'll unpack that.
The fundamental thesis for Essex is built on structural realities that take years to fully play out. The severe multi-decade supply-demand imbalance in California housing, the exorbitant barrier to entry for homeownership, and the impending 2027 supply cliff are massive macro tailwinds.
The wind is at their back.
Yes. Essex has constructed a balance sheet capable of weathering any short-term economic volatility, and they are perfectly positioned to command immense pricing power as competition vanishes over the next 24 to 36 months. The fundamental machinery of this business is incredibly sound.
I completely agree with the structural thesis, but I have to inject a heavy dose of reality for the retail investor listening right now. If you're looking for a high beta tech stock that is going to explode by 40% in the next 2 quarters, you're looking in the exact wrong place.
Essex is not that vehicle.
We've established that 40% of their portfolio in Southern California is dragging heavily, handcuffed to a sluggish national economy. We've established that their booming Northern California market is artificially restricted by the AB 1482 rent caps, meaning their massive revenue potential is doled out in small incremental drips rather than a massive wave.
The slow burn.
And we've seen that their immediate Q3 guidance forecasts and earnings drop due to seasonal and planned maintenance expenses. All of these factors combine to make Essex a steady tortoise, not a sprinting hare.
I completely agree with that characterization. It is a defensive wealth preservation play. If you already own Essex in your portfolio, the data strongly suggests it is a hold.
And if you don't own it.
If you are looking to initiate a position, it represents a buy-on-the-dip opportunity for a dividend-focused investor who wants exposure to premier, irreplaceable West Coast real estate without the existential heart palpitations that come with high-leverage operators.
You buy Essex so you can sleep well at night, secure in the knowledge that in 2027, when the construction pipelines are entirely empty, Essex will be quietly, legally pushing rents to the maximum allowable limit and harvesting massive amounts of free cash flow.
Which brings us to the final synthesis of this deep dive.
Let's sum it up.
Essex Property Trust is navigating a highly complex, localized map. They are currently riding a structural tech wave in Northern California, acting as a patient harvester of delayed demand in Seattle, and carrying the dead weight of a stagnant Southern California economy.
And they are executing this balancing act, strapped to an impregnable balance sheet that completely shields them from the current interest rate chaos devastating the rest of the commercial real estate sector.
They are ruthlessly managing the operational levers they can actually control, optimizing property taxes, timing their maintenance expenses, pruning joint ventures, and driving tenant retention.
While they patiently wait for the 2027 supply cliff to grant them undeniable leverage over the market.
It's a compelling narrative, but as always, we want to leave you with a final provocative thought. Something to integrate into your own long-term risk modeling that wasn't explicitly spelled out in earnings call.
What's the wild card?
We have spent an hour dissecting how management relies on physical tech office expansions as the primary catalyst for future demand in Seattle and Northern California. Their entire growth thesis is fundamentally predicated on the idea that the innovation cycle inevitably translates into physical bodies occupying physical desks in close proximity to tech headquarters.
But if you look out over the next 36 to 48 months, the ultimate wild card for Essex's stock price isn't interest rates, it isn't supply pipelines, and it isn't property management execution.
The ultimate systemic risk is corporate HR policy.
Exactly. What happens to the Essex business model if the tech industry undergoes a fundamental, permanent paradigm shift in how they scale their workforces? Management noted the AI boom is driving current demand, but what if the ultimate result of that massive investment in AI allows these mega-cap tech companies to permanently decentralize their operations?
What if they realize they can achieve historic growth metrics without needing to pack tens of thousands of highly paid software engineers into the most expensive zip codes on the West Coast?
If the geographical link between premier tech employment and physical location becomes permanently decoupled, how quickly does Essex's extreme regional concentration transition from being their greatest competitive moat to their most fatal liability?
It is the existential question hanging over all West Coast commercial real estate right now. If a senior engineer can command a $500,000 salary while living in Montana, the 6.5% rent growth in Silicon Valley evaporates overnight.
The underlying demand thesis just crumbles. It's a risk that is incredibly difficult to quantify on a spreadsheet, but it is absolutely essential to consider when evaluating a company this heavily concentrated in a single sector's geographical footprint.
The macroeconomic landscape is incredibly murky right now, but by stripping away the accounting noise, understanding the local legislation, and asking the difficult questions about long-term demand, we can start to bring the true value of these assets into focus.
Well said. We've covered a massive amount of ground in this deep dive, pulling apart everything from the nuances of FFO accounting and the history of California property tax law to the exact mechanics of construction financing and the microgeography of tech expansions.
It's a lot to digest.
It is. We hope this comprehensive breakdown of the Essex Q2 2026 earnings call has equipped you with a sharper analytical lens for your own investment journey. Thank you for joining us as we unpack the source material. We always encourage you to pull up the transcripts yourself, question the corporate narratives, model the downside risks, and keep executing your own rigorous research. Until next time.
Take care and keep digging into the data.
And remember, whether the market looks like a clean, predictable chart or a chaotic regulatory maze, the underlying truth is always hiding in the mechanics if you know exactly how to look for it. We will see you on the next deep dive.